Welcome to another CEO Wisdom Pod with Charles Thoma. He's CEO and founder at Cognitive Corporate Finance in Madrid, Spain. We're going to talk about startups, private equity, funding, venture capital, and real estate transactions today. This podcast is brought to you by podpire.com. If you want to start your podcast and scale it and monetize it the unconventional way, go to podpire.com. Charles, welcome to the pod. Tell me a bit more about yourself and CCF.
Sure. Thanks, Charles, for that. Well, I'm the founder and CEO of Cognitive Corporate Finance. We are a sell-side corporate finance firm. So our job in life is to help companies raise capital. We help companies, we help funds, we help sellers of businesses to find investors and buyers in the alternative investment space. Basically, investment funds of all shapes and sizes, venture capital funds, PE funds, credit funds, real estate funds, corporate VCs, corporate M&A departments, etc. And we walk them through the process from start to finish.
How did you first get into that, and why did this get your attention more than other sides of business?
So I've been pretty much around every stage of life, of the stage of a company's financial life, from growth to acquisitions to disposals to restructurings and liquidations and rebirth post liquidations. And one of the things that struck me as after the financial crisis, during which I worked on the Lehman's Chapter 11 for a couple of years, that there's lots of theory that doesn't really withstand reality in the financial space, and there's lots of stuff that we saw that basically just fell apart from 2008 onwards. And I thought it'd be a really good idea to get back to basics and to actually, help our clients understand, what is a basic financial instrument, the capital you ask against the rights you propose to the investor. If you're proposing equity to an investor, if you're proposing a debt instrument, it's not the same thing. And what you're proposing should be on market. That also then, generates a question, well, who wants these financial instruments? If you're looking for 10 million in equity or 10 million in debt, you're not going to be speaking to the same people. You're going to be speaking to different investors. Therefore, you need, to understand who has what kind of strategy, which then led us to say, well, actually, we need to map the investment strategies of a large number of people, of investors specifically, which is what we did, right? So we, basically today we've mapped about 20,000 institutional investors from the point of view of, what their investment strategy, their investment mandate, their investment thesis consists of. And that basically means just understanding where they invest, in what countries, in what sectors, how much, and where they invest in the balance sheet or outside of it. And we thought, so long answer to a short question, we thought that basically that it was getting back to basics, who wants what kind of risk and what makes sense, and what's an on-market instrument.
And why this specific field? Is it because it generates tons of money? Because you're also an author. I mean, you could do that full time, right? Like, why that part? Is it because it awakes a part of your curiosity as well? It's complex deals, it's adrenaline filled. Why?
So, good. I don't know. I don't know if I have the answer. I'll give you bits of answers to that. So the first thing is because I created basically the company right after the financial crisis, and a lot of people came to us saying, we need capital, which then, generated a whole range of consulting work for us to help understand what they needed, why they needed it, and where we go and find it. So basically, the market kind of shaped that for us to a certain extent. So while we were collecting this information and this knowledge from the market, we thought, okay, we're actually capturing a lot. Why don't we just put it in a book so that we can help our clients and anybody who's interested understand, what it is to go tap into the investment pockets of VC funds, PE funds, credit funds, litigation funds. I mean, there's a whole variety of investment animals, quote unquote, out there. And we thought, okay, it'd be worth putting in a book. And of course, we started publishing technical papers as well to kind of focus on some of these areas. And yeah, I mean, it is exciting. I think there's a whole range. I mean, it's most importantly, I think people have fantasies or nightmares about what investment funds look like. A lot of people think of, funds sometimes as vulture funds, as people just like rip your company apart and sell it, strip it and sell it for parts. Others have, these completely exaggerated ideas of what a fund and can and can't do for you. And we thought it would be, there's a lot of hand holding that's required that we think we're capable of doing, which consists of, helping people understand, what is the right kind of capital for their business at this moment, right? And just being able to answer that question is satisfying. I mean, it's great to see that you're, adding value, and that, where people come to us and say, I'm, in my mid-50s, I've created my business, my kids won't take it over because they have other ambitions. I can sell now, or I can grow the business and raise capital, make it grow times 2 or 3, and then sell it then. What do you think? Those are huge questions. There's really interesting questions, and when people come and open up and ask these things, we're able to give the answer. We're able to give the answer for sell now. We can tell them what it would look like. If we tell them no, raise capital and grow and sell in 5 to 10 years, we can tell them what that looks like. And people open up. They're really bearing their soul to many frequently, and being able to answer those questions, help these people, and value is very satisfying.
You've worked at various M&A firms, notably Alvarez and Marsal. You started your career as well at KPMG. What did you learn from all of these companies before you decided to start your own company?
How not to mess up, basically. So I started in strategy consulting in the UK. Then I moved when I went to KPMG restructuring. It was to help do restructurings and turnarounds, so helping troubled companies. So I saw a lot of companies that had problems, and understanding what the problems were actually was part of fixing it. We also helped the shareholders of these companies to figure out, well, what they could salvage out of it. We also held the creditors of those companies to help them figure out, what cash could they get back in the event of a bankruptcy proceeding. So that was one part of it. So we were doing a lot of operational restructurings, but we also did a lot of financial structurings and securitization restructurings. And that's when you see, when financiers kind of get too clever for their own good and invent things like CDO, CLOs that end up blowing up, right? And that's back to your initial question, like why I created, cognitive corporate finance. Yeah, it's seeing that there's lots of silly ideas that get put together, and that convince people to put capital into them is I thought, well, let's not do that anymore. Let's keep things simple. Let's make sure we understand, we can explain to the investors on behalf of our clients, what they're investing in, what their cash is going to be used for, what returns is going to generate, for what kind of period of time, and make sure that everyone's aligned, that, our client, the seller, has a very clear and transparent offer. The investor who enters into it knows exactly where he or she's stepping into. There's no unpleasant surprises, and if there is, it's somebody else's fault, but not ours. And we hope that there shouldn't be. Obviously, we don't guarantee anything, but we hope that that in so doing, you have a really healthy relationships between the investee and the investor.
So what do you occupy your time with nowadays? You write books, you consult for clients. How do you split your time, and what are your top goals this year?
So we're from a business point of view, our top goals. So last year was a hard year. So we had, it was kind of basically just flat, right, all around. I mean, very little happened for anyone in the market. So a lot of things just got pushed back to 2024. So we're seeing a lot of business. So our objective right now is to convert as much of these deals as possible, and it's looking really, really solid. And once we do that, we need to scale up our tech. So, we've got our own tech platform that we've got these 20,000 investors mapped out. We need to take it to the next level to be able to develop new functionalities, to be able to also go beyond Europe, which is right now we're pretty much Europe focused, 80%. So we like to go to, Asia and maybe Latin America. And from a personal point of view, I need to think of the next book. I haven't got my head around it yet, so that's probably going to take me a couple of years to figure out what it is.
There you go. You wrote a book giving advice to your two sons. What would be your top advice to future generation and specifically future founders?
Wow, you really dug deep. So I think and I was having a discussion with one of my sons yesterday. I think find your passion, I think is the most important thing. I think if you really enjoy what you do, then working 14-hour days becomes a breeze. It's feather light. If you don't enjoy what you do, working an 8-hour day is a nightmare. So I think it's really making sure that you're honest with yourself with what you do. If you think you're going down the wrong track, change, step back, start again. Or if you can just step sideways, do it. But I think, really making sure you know what you're doing and why is really the key to success.
Right. And the Madrid startup ecosystem, how's it going? I had an incubator in Barcelona, B Combinator, I think, it was called. And, I felt that back in these days, about 1 or 2 years ago, the startup world was really slow. It was tough to get funding and so forth. How's the Spaniard startup ecosystem, precisely Madrid and Barcelona?
So it's they're booming. I mean, the just big picture. I think Brexit just basically just brought a lot of capital back onto the continent, and a lot of that capital came to Spain, right? A lot of the activity came to Spain, and within Spain, Madrid is really the powerhouse of the Spanish economy, right? There's like reports about it and articles about it pretty much every week. The number of investors who show up at the likes of South Summit just never stops growing. Now there's more investors from abroad that show up in Spain than investors from Spain. So I mean, from our experience, I'd say about there's 80% of the capital that we see entering ventures into Spain is non-Spanish capital, right? So there's a lot of non-Spanish capital looking to invest in Spanish ventures. The same applies to real estate. The same applies to corporates. Maybe not in the same proportions, but there's a huge. I mean, Spain is super healthy. I think it's the second fastest growing economy in Europe this year or last year. And Madrid specifically is just basically vying for top four positions with Berlin, Paris, and London. Barcelona is still dynamic. I think there's still a lot of activity in Barcelona, but it's not. It has a lot of an established base of large international corporates, and the tech sector is very strong there as well. I think it's going to continue to stay strong. I think Madrid's just going to grow faster.
I'm reading your PDFs with like various types of funds, and couple caught my attention. Credit funds, so senior debt, credit fund, mezzanine, distress funds. That one is probably the most interesting to me. Turnaround funds, litigation that ethics might be a problem for me, but what are these different types of funds and which one is the most exciting to you?
Let me just pick up litigation funds. And actually, it's super interesting because very often it's small companies get taken to the cleaners by large companies. And when you're a small company and you have to, take Samsung to court or the United States government, etc., most companies don't have the capital, and they say, well, I'm going to dedicate, $5 million or euros to litigate against Samsung, right, or for whatever, or any large corporate. So litigation funds are there to help the small guy, right? They're saying, listen, you don't need to spend that capital. We'll spend it for you. We'll take a chunk of your earnings, typically 30%, but it's good value for money because these companies can then dedicate their capital to growing the business. So I just it's a really exciting. It's a very niche market, and we find it's a really interesting space. Um, they're all they're all very exciting. They all have their own story to tell, right? So I think the ones that are the one that have the wind in their sail right now are growth equity funds and credit funds, right? So right now the economy is doing broadly well. Sure, Europe, the Eurozone is just a bit flat now, but broadly the mid cap and SME space is doing well, and there's lots of capital looking for growth equity. Growth equity is when companies go from largely national and a bit international to very international. When they raise 10 to 50 million to basically become European, or if they're already in a couple of states in the US to become American. Credit funds do the same thing, but with debt instruments, right? And there's lots of given the fact that banks have largely withdrawn from the SME lending sector since the financial crisis, credit funds have come into their own, and there's lots of credit funds out there that provide that growth capital, that acquisition financing capital that banks have come in and out of. I mean, now the banks are kind of coming back into it, but it's credit funds are here to stay. 20 years ago, no one had heard of them, right? Or to a large extent. Now they're really part of the panorama of investment alternatives.
Litigation fund, I just think that last founder that I'd fund would be litigation oriented. As a founder, you need to spend time building a product and you need to absolutely stay outside of courts. And if someone is messing with you, well, too bad, so sad. In my opinion, you just, pivot and go elsewhere. You don't ever want to spend your life in a court. It's such a win-lose game, and it's such a waste of energy and potential. I think that courts is one of the human inventions that we maxed out the most nowadays. In first place, I don't think it was a good invention. I just think like punishing people is a bit archaic. That's not how you have people grow and so forth. That's not how you resolve difference. Obviously, it's better than killing or stealing, right?
Yeah.
But I believe it's completely toxic. Like I think founders should relentlessly focus on product market fit. I often speak to founders that are like, oh, I have this IP, and that's what's going to make my startup. Well, that's another dumb human invention, IPs, that's not scalable. I think founders should relentlessly chase product market fit and nothing of the human conventions or what governments tell them to do, whether it's a court or an IP. What do you think about that?
So I think so. IP is not the end all be all of a venture, but it is. I think it's a key ingredient in the success of a company. You need, and intellectual property comes in various forms. So patents, copyrights, trade secrets, and industrial design and brands. So you need to know if let's say if you're a tech company, you need to know where your technological blocks are. You need to know that they're your own. You need to have them protected to make sure no one steals them from you. Because if you don't, then someone will, right? The chances are people will say, "Hang on, what you think is your idea is actually my idea," and then then you've got a problem, right? And then you have to litigate, right? So the whole idea is to kind of protect yourself, make sure you're ready for battle, so you don't have to fight. So it's important to make sure you cover the basic aspects and you don't go completely naked without any IP protection whatsoever, so that nobody takes your lunch, right? And unfortunately, sometimes people do, and then you do have to litigate, and you're right. I mean, that should not be the focus. Your focus should not be on litigation by any stretch of the imagination. But sometimes it does happen. I mean, we've had clients that were, really brutally robbed of what was legitimately theirs, and basically the business was gutted. And so we think, well, when that happens, what do you do, right? You can't focus on the business anymore. It's gone. Somebody's taken it from you. But you're right. I don't dispute what you've said on litigation funds. I don't dispute what you said on IP. I think, unless you've got something, unless you're selling something somebody wants to buy, then you're not focusing your efforts in the right place. You do need the minimum to make sure that what you think is yours is actually yours. But you're right. I agree with you.
Yeah, well, it depends if like you're aiming for like a 2 or 5 or 10x returns, like me, I tend to view life in my own lens, which is always aim for the $1 billion and the unicorn. I'm aiming super big, and I take examples of Zuckerberg, for example. Well, he had lawyers eventually that once he had major product market fit, right, then a corporate team came in and sort of protected his ass. And yeah, I feel that these founders are just relentlessly focused on product market fit. If someone copies you, well, again, too bad, so sad. You're not full stack. You're either too busy building and you're not enough good at selling as a founder or CEO. So you just got beat, and to me, it's even fair if someone copies you and brings it to market quicker. Well, they have a GTM machine that's more advanced than yours, right? I feel that as a humanity, it's kind of our duty to just take what the others have built and bring it further. And if you can be that person, well, it's too bad, like you lost that this brutal sport that is business. I feel that, yeah, if someone copies you, like most of them, they just don't know how to bring it to market. It's just like China trying to bring stuff to market. They don't stand a chance against my sales skills, for example. So they can copy me all they want, but they don't have the full stack like I do. So anyway, that's just like my black or white
Yeah.
opinion. The credit funds, why do you think they're so prominent nowadays? It's like people pretending to be banks, if you want, and they might have better conditions than banks. How do you run a credit fund rightfully and making sure that y'all actually get your money back?
If as a credit fund manager or as somebody who takes money from a credit fund, you mean?
Yeah, credit fund manager.
So, a credit fund, just to give some basic numbers, would be, a vehicle that maybe has from 250 to a couple million to a couple billion, and then they would lend to medium to large corporates, and what they do is lend in situations that have a higher risk components than banks are willing to take. So banks typically, and this is a very an oversimplification. Banks like to lend to established businesses that they've known for a number of years, and they like to take the lowest risk for their capital. Therefore, they typically charge the least, right? But their conditions can be pretty harsh. They ask for a lot of guarantees. They ask for a lot of pledges, mortgage securities on real estate, pledges on shares, pledges on receivables portfolio. So, they have some very constraining, typically they have some very constraining conditions that they offer. A credit fund, by contrast, will say, look, I'm not a bank. I can't take a mortgage security on you. I will give you money that you can dispose of more freely with fewer strings attached. In exchange for example, instead of lending you on a 365-day basis, I will lend you for 5 years, on a bullet basis. So, no amortization whatsoever. In exchange for which I will charge you a much higher interest rate, 10%, plus some sort of equity component, so I can get, some juicy returns. I'm not as well protected as the bank. As a credit fund, I'm not going to have the same level of protection as the bank. So in case of bankruptcy, the bank gets their money first, I'm next, and then the equity takes whatever is left, if there's anything left. So that being a credit fund means, understanding where you are in the priority rankings in case of bankruptcy, and pricing yourself accordingly. And why do people come to credit funds? People come to credit funds because, first of all, they don't, some companies can grow really fast, and they may have raised equity, and never really got around to actually raising banks apart from having just an overdraft facility. And then they say, well, I actually need debt now. I need to make an acquisition. And then they go to their bank, and the bank says, we barely know you. You're small. We're not, we're not in the business of just funding whoever comes through the door. I'm exaggerating, how banks behave, because banks aren't like that necessarily. But we're credit firm will say, hey, come in. We've got solutions for you, right? And they're more flexible, they're faster, and they price a premium, of course, right, in exchange for it. So I mean that's what a credit fund does. And here there's a lot of space, in these days in the market for them, because there's lots of solid projects that have solid cash flows that aren't bankable. Literally bankable meaning a bank will not be able to lend against it, but somebody else can, who's willing to take a higher risk, i.e. a credit fund.
Interesting. Well, thank you for all that information, Charles. Where can people find out more about you?
Well, on our website, www.cognitivecf.com, and LinkedIn, of course, and now on YouTube with this interview.